To try and generate £10,000 a year from income producing funds, you'd need a portfolio size of £200,000 that could achieve a yield of 5%. With £250,000, you would need a yield of 4%. Now, there's no magic number of funds that investors should be aiming for, but for me, around 10 to 13 funds would be a good amount to achieve plenty of diversification for the investment amounts of 200k and 250k. Spreading your investments across a number of different funds and investment trusts, it gives you diversification. By spreading risk, there's a good chance that if some funds lose value, it'll be offset by gains in others, or that losses one year will be followed by a recovery the next. By having a large number of funds, so 10 to 13 rather than the 5 to 8, which I suggested in the £5,000 annual income video, you could consider having exposure to alternative investments, such as infrastructure and renewable energy. An example in Interactive Investor's sustainable ACE 40 list of rated funds is VT Gravis Clean Energy Income. It has a yield of 4.3%. Another option is Greencoat UK Wind, which has a yield of around 5%. As the name suggests, it invests in UK wind farms. A key attraction is that the trust aims to increase its dividends in line with retail price index inflation. Now, bear in mind that alternative income strategies, they should form a small part of a portfolio. The core should be invested in more mainstream funds, such as UK equity income, global equity and bond funds. A possible split, depending on your risk profile, age and time horizon, could be to have 50% in shares, 30% in bonds, 10% in property and 10% in alternative investments. Having the bulk of exposure to equities will hopefully give a mix of growth and income. As mentioned before in this video series, bear in mind the fund yields, they are an estimate, they're backwards looking and they are not guaranteed. And for those paying themselves an income, particularly those at retirement, risk can be reduced by only taking the income produced by the underlying investments held by professionally managed funds and investment trusts. This is what's called the natural yield rather than eating into capital growth. This is because under a scenario where stock markets fall sharply and income withdrawals are either maintained or even increased during that period, it is difficult for a retirement fund's capital value to recover afterwards. That's particularly the case if you're drawing on capital to maintain the required level of income when the market falls, as opposed to taking only the natural yield. Drawing on capital, it reduces the number of fund units you own, which makes it much harder for the fund to regain value. The phenomenon is known as pound cost ravaging, which is the inverse of pound cost averaging, the term that refers to regularly investing to smooth out price fluctuations.